3, 2, 1 diddy 1 diddy 1.
All right. Here we are, July. Year is half over. Unbelievable.
I know.
Yep.
You trying to depress me?
No.
The year's half over. You haven't done anything yet.
It is pretty amazing.
Yeah, we just got off 5 days on a sailboat.
We did.
We are certified sailors.
Certified official now.
What you got for us this week?
See. All right. So this week is going to be pretty interesting, actually. We got a rally going on in the stock market, and we're done with the first half of the year, right? If you remember back in December, the idea, the everybody's consensus was that the market would go down the first half of the year and recover the second half of the year. Obviously, the market's gone up the first half of the year, so it's going to be very interesting to see what happens the second half of the year. So with that in mind, basically, I went and looked at like 3 experts that are on the bulls side and 3 experts that are on the bears side, and just to kind of give some perspective, like these are all 3 bulls, 3 bears. They're all experts in the field. They come at it from different directions, and all their arguments are very credible. Right. So, I mean, the idea.
That's normally how it is, right? I mean, this is only to show that nobody has a crystal ball.
Right.
The biggest experts in the world can disagree, right? So you got 3 bears, you got 3 bulls, you got us in the middle going, where do I go?
Right.
What do I do? Right. And hopefully that's what you guys will get from this show, because it's you never know, right? There's no way to know.
Right.
Be for sure, right?
Yeah. There's no way to know. The goal, hopefully, from what we're providing, is basically distilling all this stuff. Not distilling it. So if you can know as many of these possibilities or arguments that people make as possible, and then follow along the market and use technical analysis as like guide rails, that's kind of, in my view, the best way you can do it.
Right. That's as good as it's going to get.
Yeah.
Right. I mean, if you take in all the information you can and you have a plan, see which one of these kind of narratives matches up with your plan. And you're like, okay, this is the one. This is where I'm going to follow. Right.
Yeah. I mean, if you find a person that is a really good forecaster, or someone that you agree with the way they look at the world or whatever, and you follow their forecast, anybody who's forecasting is attempting to use a crystal ball one way or the other. And all 6 of these that we're going to talk about are kind of doing that. And what we're trying to do is take it all in and then watch what happens on the market and respond to it. Okay, and then we'll take a look at Apple versus the S fund, and then the weekly TSP fund charts. So the bulls, there are plenty of bulls out there. These aren't the only 3, obviously. There weren't very many bulls, last summer, but this summer they're kind of coming out of the woodwork now that the market's turning around. There's not a whole lot of written stuff anymore. Most of it now is on YouTube. Most of the good stuff is on YouTube. And so some of these, I found articles, some of them I kind of took the highlights from YouTube videos, and I put the video links in there so you guys can go back and watch them if you want. So we'll look at J.C. Peretz, we've talked about. Tom Lee, we haven't talked about too much, but he's like the perma bull on Wall Street. And David Hunter, who's a contrarian, which is really interesting. We'll see what he thinks has happened going forward. And then we'll get to the bears. All right. So kind of keep in mind, the more of these that overlap, I think is interesting, because then the more sort of validity, right? So this is from a last week's email from JC. JC's from Miami. He's kind of obnoxious, and he writes that way. So this is an email from him. It's not like an article that he did or whatever. So he's saying, historically in bear markets, the S&P 500 doesn't go up every quarter. In fact, by definition, if the S&P 500 is going up every quarter, we call those bull markets, right? Historically in bear markets, right, if the S&P historically in bear markets, the S&P doesn't go up every quarter. So we call bull markets when they do go up. Today is the last day of Q2, and the S&P 500 is up over 7% for the quarter. S&P was also up over 7% in the first quarter. It was up another 7% in Q4 of last year, right? So this represents 3x the average market return for each of the past 3 quarters. Along the way, we've seen consistent sector rotation. That's debatable. We'll hear about that in the bears. And an expansion in market breadth, also debatable, both among sectors in the U.S. and in countries around the globe. Again, also debatable. This is the type of market environment where investors are being rewarded for owning stocks, not for shorting them. That's for sure true. If you're trying to short things in this market, you're getting killed. But we can see on the charts when he's talking about a clear expansion in breadth. I'm not tracking with him because we'll show in the charts that it doesn't seem to be true. If things like fundamentals or anything about the economy kept you from owning stocks for the past few quarters, perhaps it would be best to start to ignore those fundamentals in economics and instead focus more attention on the only thing around here that is going to pay anyone price. Only price pays. Humans will use any data point except price to justify the poor decision making. Don't do that. Price is the final arbiter. That you cannot argue with. Price is the final arbiter. Tom Lee. So S&P 500 exited a bear market on Tuesday. This is from maybe 2 weeks ago. It's this MarketWatch article. So S&P 500 exited a bear market on Tuesday. And that's when they're officially saying we exited the bear market because the S&P 500 is up 20% from the October low. So they're calling that the end of the bear market. While a closely watched gauge of stock market volatility dropped to more than a 3-year low. These two things are related, says Tom Lee, who runs FundStrat Global Advisors. So his whole premise is about the VIX. Okay, the CBOE is a Chicago Board of Exchange Volatility Index. It's an options-driven measure of expected volatility in the S&P 500 over the coming 30 days. Traded as low as 13.5 on Friday, its lowest since February 2020. The gauge's long-term average is near 19. A subdued reading, so a low reading, indicates investors are feeling optimistic. The VIX averaged 25 in 2022, while the S&P posted a decline of 19.4%. So when the VIX is low, you can call it optimistic, or you can call it complacent. Okay, so if you're a bull, you're saying a low VIX is a good thing. A very low VIX is a very good thing. If you're a bear, you're saying a very low VIX implies that people are complacent. It tends to correspond with the bull bear index, like the greed index being really high and all that. Okay. So he quotes, the VIX impact is the least appreciated. Our work from December 2022 shows that in the last 30 years, post-negative equity year, which was 2022, the VIX is down year over year. The median gain is 22%. So as they were looking back in December when they're doing this research, they're looking back to the October low, and they're saying when the VIX is down year over year, from then the next year, the median gain in the market is 22%. VIX's role is larger than the impact from moves in the U.S. dollar, earnings per share, or even bond yields, Lee said. So obviously all that is very arguable. The dollar is important. Every fundamental analyst would say that earnings is the most important thing. And the bond market is much bigger than the stock market. So to say that the VIX role is larger than any of them, it could be. It just depends on how you do the analysis. VIX trajectory, in other words, was the single biggest determinant at the start of 2023. It seems to be playing out today. So now what? Right? We've had a huge year rally. Lee said with the VIX below 14, it likely won't be a driver of future gains. So while the VIX at its current level isn't necessarily a buy signal on its own, we still see upside drivers for the S&P over the next 6 months, the main driver being that inflationary pressures ease faster than consensus expects and at a pace that will allow the Fed to slow its pace of hikes. It could turn out that way. Inflation is definitely coming down. Whether or not the Fed continues to hike rates, they certainly seem to imply that they paused this time in June. But they said they need to make 2 more rate hikes by the end of the year. So maybe Lee is right. Maybe inflation will come down fast enough and the Fed will not have to continue rate hikes. We'll see. Fundstrat's base case remains that the S&P will gain more than 20% in 2023, with a 4,300 level serving as a waypoint that will eventually give way to equity markets making new highs this year. And it's certainly a possibility. It's one of the things in the newsletter this weekend. We're looking at the 2 possible Elliott wave counts, and one of them is that the S&P makes new highs this year. Okay, so he bases his whole thing on the VIX. Okay, and so here's a chart of the VIX versus the S&P 500. So the VIX is in black, S&P 500 is in orange, and what he's saying is when the VIX, so here's the numbers on the VIX, right? 13.59 is where we're at right now. When the VIX goes down, S&P 500 goes up. When the VIX goes up, S&P goes down. VIX goes down, S&P goes up. And where we are right now, which I think is really interesting because this is as of Friday's close, S&P had a big up day on Friday. VIX is turning up. So there's a bit of a divergence there. One day doesn't really mean anything, but I think it's interesting because if the VIX turns back up, the S&P will come down. So we'll see. This is definitely an interesting turn on the VIX. And obviously, at some point, right, when the VIX is way down here, the lower the VIX goes, the closer you are to a top in the market. The higher the VIX goes, the closer you are to a bottom in the market. So, okay. So we had Tom Lee, J.C. Peretz, and now David Hunter. Okay. Contrarian Macro Advisors exec, which is David Hunter. This is from the easiest way to get to this is YouTube called Kitco News. But if you go to news.bitcoin.com, this is where this article comes from. But Michelle McCory, who they interview, I guess is the interviewer for this article, is the host, one of the hosts at Kitco News. So David Hunter calling for a global market melt-up in Q4, and at the same time warns that an 80% downturn will follow. Okay, so if you follow David Hunter at all, he's mostly on Twitter, but he's been calling for a melt-up for a couple of years, a huge melt-up.
Explain melt-up versus melt-down.
Yeah, it's the exact opposite. I mean, we'll get to it, but he's calling for 7,000 on the S&P 500 by the end of the year, right? So up
shouldn't we just call that an explosion and not a melt up?
Yeah, it's insane.
Like I don't get the melt up versus melt down.
Well,
nothing melts up, but
yeah, no, it's a blow off top basically. Right. I mean, his long-term argument is that we've been in this bear market or this bull market since 1982. And this melt up, as he calls it, is the final leg of this bull market that started in 1982.
Before a meltdown.
Before a meltdown at 80%. So, but he's been calling for this blow off top for a while, and it seems like he's going to get it. So, David Hunter, chief macro strategist at Contrarian Macro Advisors, predicts an interesting development for global markets in the fourth quarter of 23. So it's timely, right? According to him, global markets will experience a remarkable surge aptly described as a melt-up. However, this surge will be short-lived, as a substantial downturn is expected to follow. Hunter emphasizes that after this rise and fall, we won't witness the same lofty peaks of the 41-year secular bull cycle, right, which we said going back to 1982, for many years to come. So whenever we hit the next high, that's going to be it for a long time, according to David Hunter. He painted a picture of the S&P soaring by a staggering 36%, while the value of gold would ascend to $3,000 an ounce by October. So gold right now is a little bit under 1,800, I think. And so to go to 3,000 by October is almost doubling in the next couple of months. However, Hunter cautioned that these bullish scenarios will be fleeting as an imminent and significant market boom looms on the horizon, paving the way for a profound recession. So he's not that, other than his huge swings, he's not that different than what the bears are saying and what everybody the economists have been saying, that a recession is coming. So my S&P target is 6,000 to 7,000, Hunter explained during his interview with Michelle McQuarrie. My targets are gold at 3,000 pre-bust and silver to 60 pre-bust. We'll probably see most of the melt-up move by the end of the summer, which could mean Labor Day, but it could stretch into September. So what exactly is a melt-up? Traditionally, these market phenomena resemble bull traps, serving as deceptive and unreliable signals of an impending market surge. The gains experienced during a melt-up are often viewed with skepticism because, despite the temporary upward momentum, the underlying fundamentals of the market continue to deteriorate. That is exactly where we are right now. The underlying fundamentals are absolutely deteriorating, and the skepticism, it's called the market climbs a wall of woe, is how they term it, right? So when if people don't believe, because the fundamentals are deteriorating, and they watch price continue to go higher and go, it's not possible. And the longer you say it's not possible, the higher price goes, until everybody finally throws the towel in and says, all right, the market's been going up for this long, it's going to keep going, and they buy, and then it rolls over. It's just how it works. But that is absolutely, and that sets the stage for a potential blow off top or melt up, and that is exactly the circumstances that we're in right now. Throughout history, melt-ups have frequently paved the way for subsequent meltdowns, reminiscent of the notable fall melt-up of 2011, aptly dubbed the Great Surprise. So according to Hunter, Federal Reserve's implementation of quantitative tightening measures has surpassed the optimal threshold, pushing it into the realm of going too far. While speaking with McQuarrie, Hunter insists we are in uncharted territory. The formula is really economic fragility caused by the pandemic, plus potentially the biggest policy error, which was over-tightening, in history of central banks, and leverage, right? All the debt sloshing around the world. You got a formula which takes a normal recession into something far worse. Hunter explained that the type of bust he envisions will entail markets recording an 80% drawdown. And while he predicts gold will reach an all-time high this year, precious metals like gold and silver will drop back to today's levels. So what he's saying is during that 80% drawdown, everything goes down, right? I don't think very many assets are going to be able to escape a deflationary bust, which is what he predicts is what's going to be termed this 80% drawdown is going to be a deflationary bust. And if you watch any of the guys on Wealthion, there are a lot of very smart people that think as soon as we get this inflation problem under control, right after that is going to be a deflation problem, which is worse than inflation. And we will definitely be talking about that if and when we get there. The macro strategist concluded, however, that gold and silver will see upsides following the bust, and both could rise 10 times higher in value after the boom. So along with most of the sort of macroeconomic guys, once this recession happens and the market actually does fall out, the bottom from that, everything comes down. When you have a deflationary depression, everything comes down. And so you can't buy gold as a hedge against that because gold's going to come down too. But once this thing ends and bottoms out, gold, silver, all the commodities and long-term treasuries should be what drives everything higher, and probably tech also. But that's kind of the bigger picture rotation. When they talk, it's not really sector rotation, but the rotation of things. That's what they expect. And so definitely you want to keep an eye on commodities and precious metals, which are going to go down when everything else does, but they're the ones that are going to lead it back up. Okay, so those are the bulls. The bears: Jeff Hughes, JWH Investments, Ted Oakley, and Michael Green. There's a ton of bears. If you've been watching Wealthy on at all, it's for the past year, it's been all bearish. So you can get plenty of different bear perspectives there. So this one I took off of Stock Charts TV. You don't need a membership, I don't think. I'm pretty sure you don't need to be a subscriber to the site to get Stock Charts TV. Just go to stockcharts.com and it's one of the tabs at the top. And so he's saying S&P is a ticking time bomb. Okay, and this is about a week and a half ago. So what he's talking about here that we're going to look at is this black swan alert, the VIX divergence. I didn't put up the chart. It's a little bit difficult to see of call option volumes are off the charts, but what that means is options traders are betting in a huge way, right, off the charts, in a huge way that the market's going to keep moving higher.
No pun intended.
Yeah. I mean, that's like I said, from a bearish perspective, the more people that think the market's going higher, that's great. Everybody's piling in, right? From the bullish side. From the bearish perspective, when everybody's on one side of the boat, the boat's going to flip the other way, right? So it just depends on how you want to look at it and who you want to follow. But that's the idea of call option volume being really high. If it was put option volume being really high, it would mean everybody is really bearish on the market and we'd be much closer to a bottom. And then the short-term Elliott wave count. So he had some pretty interesting charts up there. I'm not going to kind of get into all of this, but this is a chart of what is called the skew. The skew measures the slope of implied volatility. Don't worry about that. The important thing is the skew index is coming off back-to-back highs at 158 and 157, so right here. Okay, and it's at the high point that it was back in January 2022. As skew increases, so does the risk of a left tail event. The risk of a black swan event, really, like something major happening. A level above 150 implies a greater than 15% probability of a 2 standard deviation downside move in stock prices. So 2 standard deviations, I don't even know how to explain that. It's a big move. So that's skew. That's the top half of the chart. The bottom half of the chart is the VIX. Okay. The skew is one measure of volatility, and the VIX is another measure. And he's just comparing the two here. So VIX is a proxy for standard deviation, captures the first layer of perceived risk, while skew captures an additional layer of risk. High values of skew can occur in conjunction with both high and low VIX values. So they don't correlate exactly. But when low values of VIX, which we are extremely low here, when low values of VIX occur with high values of skew, the risk of a black swan event is at its most elevated level. All right, so he's basically sounding the warning bell that, the black swan event is like 1987 when the market drops 20% in 2 days. That's like a black swan event, right? It's not the market rolls over and we make new lows. It's a major black swan event. And again, this was from about a week ago, so it didn't include last week's price advance. But he's saying yesterday the skew index reversed sharply, which was this, sharply lower to break its uptrend, while the VIX closed at a 40-month low, right? So he's saying, are the alligator jaws starting to close? Because if the skew comes down and the VIX goes up, that's your black swan event. So just keep it on the radar. That's all. the VVIX versus the VIX and divergence. So the VVIX is the volatility of the VIX. So investor sentiment survey data has turned decidedly bullish. Yet the volatility index, the VIX, just posted its lowest daily close in 40 months since the S&P 500 topped in February 2020. S&P 500 topped in 2020, days before the COVID crash ensued, implying a new extreme in investor complacency. So like we're saying, if you're looking at this from a bearish perspective, it's a bad thing that the VIX is really low. It's a new extreme in investor complacency. So he looks at the same data and he sees a different thing than Tom Lee does, right? However, the volatility of the VIX, the VVIX, actually bottomed on January 6th, 2023, and has diverged positively relative to its June lows. So the VVIX is coming up while the VIX is going down, right? So we have this divergence. Historically, positive divergences between these two series have preceded sharp trend changes in the VIX. And we know a sharp trend change in the VIX at this point is the VIX going up, which is bad for stocks. So while the VIX has moved steadily lower in recent weeks, the VVIX has extended its progression of higher lows. As such, we would expect a volatility spike of some significance in the days, weeks immediately ahead. So just because we had a strong rally this week in the market certainly does not preclude a significant spike in volatility. And I don't know if I have it on the chart, but he talks about it in the YouTube in the video. He's looking for a VIX back up here at like 30. And that would put us back, not price-wise. This is obviously the VIX. It's not the S&P, but it correlates to the October low. And then the last one is a short-term Elliott wave count. I think I put this chart in the newsletter last weekend. But I also talk about this as the first possibility in this weekend's newsletter. So their preferred Elliott wave count assumes that the October 13th low was the end of primary wave 1 down, right? So you don't see it up here, but we're starting in January 2022. We came down for a 1, 2, 3, 4, 5 for a 1. Okay, and then he's saying essentially A, B, C for B, and C, right? He's calling this is a more complex a double zigzag. So primary wave 2, which is this, rather than playing out in a simple ABC pattern, is tracing out a double zigzag, right? WXY corrective form. So this is an impulse move down, a double zigzag corrective move for 2, and then the next move should be significantly lower. That's possibility 1 for us, and if you read the newsletter, you'll get my perspective of basically the same data. Last week's price action in the S&P carried the index above a cluster of formidable resistance, suggesting that Friday's high did not mark the top of primary wave 2. Then a challenge of the 78.6 retracement level at S&P 4534 may be in the cards, which is very near the point where intermediate wave Y will equal intermediate wave W at S&P 4513. So W and Y are the same length right here. So we got a little bit more room to the upside to hit both the measured move, which is this, and the 78.6 retracement level, which is right here. If we get through that level, then this count is probably wrong, which is why we talk about the 2 possibilities in the newsletter. That being said, the index did close, this was last week, this does not include, so it does not include this past week's move to the upside. So that being said, the index did close just below S&P 4426. I'm not going to read that, it doesn't matter. So a daily close below S&P 4300 basically would suggest that primary wave 3 down has begun. So what he's saying is we get below 4300 and we are in this wave 3 down. And it would be confirmed, meaning that he would start shorting the S&P 500 below 41.86. Okay. Yeah. All right. So next on the bears is Ted Oakley. This is the YouTube channel. He's saying investors face a coming scramble to stay alive, warns veteran wealth manager Ted Oakley. He's the founder of Oxbow Advisors. Been doing it for 40 years. He does usually high net worth families is where he kind of focuses on. Been around for a very long time, and so I pulled kind of distilled the highlights of what he's saying from the video. So he's saying investors believe that the Fed will save us. So if assuming the market crashes, which everybody assumes, not the stock market necessarily, but the economy, as we go into recession, investors believe that the Fed will save us, which if we're anticipating a recession, it means the Fed's going to lower rates, which is good for the market. So they're front running that expectation that the Fed is going to save us. That's what this rally is about, according to him. He does not think that this will happen this time. He doesn't think the Fed is going to save us. Most markets around the world are deteriorating with central banks raising rates into a slowing economy. And for that reason, we're headed into a global recession. And so that is kind of at odds with what JC is saying, right? Because from his perspective, all the markets in the world are getting stronger, right? Can the economy sustain a new bull market? So if we're in a bull market right now, can the economy sustain it? The top 10% right now are getting much richer because yield for cash, right? We've been talking about that. For us, it's the G fund. Yield for cash is like 5%, and asset prices are climbing. So if you are in the top 10%, inflation is much less of a problem for you, but you're getting more money for your cash and more money as asset prices continue to go higher. If you're in the bottom 90%, you don't have assets to climb. The vast majority of stock is owned by the top 2 or 3% of people in the country. Most people that are have any kind of, let's call it wealth, it's in your house. People own their houses. So the housing market is much more important to most people than the stock market is. People have 401ks, some people, and IRAs now, but most people have the majority of their wealth in their house. And so the people that do have a lot of money in the market, as the market goes up, it's great for them. But the bottom 90% are affected a lot more by inflation because you're living more, paycheck to paycheck. So inflation really hurts you if that's where you're at. Debt carried by regional banks due to commercial real estate will cause the recession in, he's saying, 12 to 24 months. So it's going to take some time for commercial real estate to have to renegotiate that debt, but it's going to be at much higher rates and they're not going to be able to do it. So the market right now, he says, is a pipe dream. It's a camouflage market. If you pull out the top 8 stocks, the market is only up 2.5% for the year. So what JC said is that the market is paying people who are buying stocks, and he didn't talk at all about the top 8. He just said, if you're buying stocks, you're doing good this year. That's really not true. If you buy NVIDIA, Apple, Amazon, you're doing really well. If you bought almost anything else, you are not doing well, right? And you can see it in the S-Fund chart. So business cannot roll over debt at 9% when it was at 3 to 4% range, when they took on the debt. Corporate bankruptcy filings are up dramatically. That is true. We have too many banks in the U.S. This was interesting. He was talking about we have too many banks in the U.S. It needs to be reduced by 30 to 50%, he actually said, which, there's this whole idea about the banks that are too big to fail are only getting bigger because the small regional banks are collapsing, and so the big banks
and they're absorbing
it.
them. Yeah. That's that. I hear a lot about that. That's a problem.
It's an interesting problem because we're the only country that has it.
Yeah.
Almost every other developed country, they have dozens of banks.
Right.
We have like 4,500 banks in the United States.
Yeah, I mean, there is something to be said for, kind of having it spread out a little bit, right? But 4,500 or 4,000 banks is. I mean, you can't drive around a major metropolitan area like ours and not see banks you've never heard of.
Right.
Like, you don't even know why they exist, right?
Well, they exist for the local communities, which is what that side of it argues, right? Yeah. It's a lot easier to go to a local bank and get a loan from the guy that you can show, your business records to and all that, versus trying to pack up all your stuff and sending it up to JP Morgan. Like, I mean, but that's what most countries do. If you only have a handful of banks,
Yeah, and so I'm kind of on the fence. I mean, I'm not on the fence. I'm on the side of we should reduce that amount a little bit. Like, I think it would add a little bit more stability.
It would
to our world. The problem with that is that if that was to happen, those too big to fail banks, it's so it doesn't really like get rid of the need for the bank. It just gets absorbed in some bigger bank. Right. And so, you're with some regional bank that all of a sudden gets sucked into some large, machine. So I don't know that actually fixes it.
No, I mean, the problem still is the debt is still there.
Right.
And so, yeah,
that doesn't go away.
It doesn't go away. No. Okay, so he's talking about Warren Buffett is sitting in with $120 billion and can't find anything attractive to buy right now. So what he's talking about in the video, he's kind of laughing. He's like, look, I've known Warren for a long time. If he can't find anything attractive in the market to buy right now,
nobody can.
Nobody can. And so that basically is saying that the market's overvalued, and it doesn't mean price can't keep going up, but it's just one more kind of thing to throw into the mix that we're most likely closer to a top than we are to a bottom. And he's saying patience is the key. There's, again, we're on the bears. He thinks the market is coming down significantly, and if you're on the sidelines in cash, you're in a good place. All right, and the last one is Michael Green. He thinks thinking we'll avoid recession is delusional. His stuff is pretty interesting. It's worth going to that Wealthy on YouTube site and watching that video. But here's kind of the distillation of it. He's saying world financial markets are clearing slowly. China reopening has not resulted in expected growth. That was what everybody thought was going to push the second half of this year higher, as China reopening generated demand for commodities and travel and everything else, and that has not happened. So with equity markets moving.
All right, guys, we had a little bit of a technical difficulty. You probably saw the show just went out. We lost connection, but anyway, we're back. So hopefully that won't happen again.
All right. Cool.
Where were you, Michael Green?
Where was I? So I was a little bit into Michael Green, but I'm just going to start over there. So, Michael Green, this is the YouTube. If you want to go check it out, his stuff is really good. He's saying thinking we'll avoid recession is delusional. Okay, because that's a big part of the talking point now. The economy is getting stronger, and we're going to avoid recession somehow. He thinks it's delusional. So if we distill out what he's talking about in that YouTube video, world financial markets are clearly slowing. Okay, that's obviously at odds with what JC is saying, but world financial markets are clearly slowing. China reopening has not resulted in expected growth. So the big argument for they thought, everybody thought the market was going to crash the first half of this year and recover the second half of this year. A lot of it was based on this China reopening trade, and that has not happened. Everybody thought that when China lifted its COVID restrictions, it would create a whole bunch of demand for commodities and oil, travel, and all that, and it just hasn't played out. So with equity markets moving higher, there's a lot of confusion. It doesn't feel like it's possible that the economy is slowing down at the magnitude that is reflected in the data. So if you look at the data, everything's slowing down, and yet the stock market's moving higher. So it's consistent with what David Hunter was saying, that these are the things that fuel a melt up, which is what we're seeing. So squaring that with the behavior of financial markets shows how much our expectations are shaped by the behavior of the financial markets themselves and not on the underlying fundamentals. The underlying fundamentals are deteriorating, but the markets themselves are moving higher. So again, these guys, they come to it from a different way, but it's the same. In the end, it's the same. So one of the key things we're seeing is this divergence between the fabulous seven, he's calling them, that's the Amazon, Netflix, NVIDIA, and the broader market, right? The Russell 2000 and most stocks are flat for the year, which is true. And it's obviously different from what JC is saying, right? The equity market is almost acting like the housing market. There are no sellers, right? So right now the housing market is not tanking because nobody's selling their house. As soon as the first person says, all right, I'll take, an offer that's 10% lower than everybody else did in my neighborhood, that's the beginning of the cascade down. And it's the same thing in stocks. No one's selling right now. So the markets keep going higher. In his example, Green, he just sold his house, and the person that bought it, their carrying cost is 3 times what his was when he owned it. Like, how you can do that, I have no idea. He talks about in the video, he's like, I couldn't not sell it. It was so overpriced, he thought he couldn't sell it, and he's not buying another house in this market condition. He's just going to rent. So much higher interest rate carrying costs around the world imply distressed selling, but obviously we're not there yet. And then the last thing, if you look at the revolving debt numbers, once all the money from COVID relief and everything, people spent it, and with inflation, what it's been for the past year, revolving debt, credit card debt has gone way up. And he's saying there is no scenario on earth where a surge in revolving credit to buy groceries is a good thing. If you have to put your groceries on a credit card, you're not in a good place. And it's not it's not good for the overall economy. All right. So the bonus chart was Apple versus the S fund, basically just to show what these guys are talking about. Apple is in candlesticks. S fund is in orange. S fund is the bottom 4,500 companies in the U.S., right? S&P 500 is the 500 largest, and S fund is the bottom 4,500. So when they're talking about breadth expansion, like you got a wedge forming there that if you Google a wedge, it generally breaks. So this is it's a consolidation channel, right? And it generally breaks in the direction of the previous trend, which the previous trend was down. So if you look at go to Google and look at wave patterns, stock wave patterns, it will be down, some kind of A, B, C, D, E, down. That's what it will generally say. And this length will be the same as this length. And then that's your correction. That's your A, B, C, and then you start moving higher. It doesn't always happen that way. Nothing's 100%, but that's what this pattern implies, okay? And the most important takeaway from this is that, here's 2023. Here's where we are. The majority of stocks as an aggregate hasn't moved much at all. Here's 2023. Apple, it's so we got this little move for 4,500 stocks, and Apple, Amazon, obviously NVIDIA, the fabulous seven they call them, have been driving the market higher. But the rest of the market, I don't know what JC is talking about, but the rest of the market since 2023 hasn't moved much relative to those fabulous seven. All right. TSP fund charts. So taken away, so you get the bulls and the bears, but if we just look at what's actually happening in the market on a weekly basis, there's no arguing that we're in a bull market, right? We had 5 consecutive up weeks. We had a down week last week, and then this week we had a big move to the upside. So on a weekly basis, RSI is looking super strong. MACD is still expanding to the upside. So it looks like the market wants to move higher. We got that 78.6 retracement level up here at around 4,500. So that's really the last critical resistance level for the bears. Okay. S fund, like I said, it's just not, it's while the C fund is those big, it includes those big 7, and it's the top 500 companies in the US, the S fund is just, it's flat. It's not going anywhere. On the positive side, we got above 50 back here, came down and retested it here and moved higher this week. So that's positive. But MACD isn't really doing anything. So unless we get above, if we got above this level, if we get up here, the S fund's moving higher. If we get below here, the S fund's moving lower. But right now it's in this channel, and until it either takes out the high or the low, it's just going sideways. I fund is not looking great on the one hand, right? This is 74. It could not get above 74 for 1, 2, 3, 4, 5, 6 weeks. Pulled back to that 20-week moving average line, tested it 74 again a couple weeks ago, and got rejected there. So that's on the downside. So clearly it needs to get above 74 before it's worth being in the I fund. Then it would go higher. If it breaks below that 20-week moving average line, if we get down here, 69, let's say, it's going lower. On the positive side, once it got above 50 back here on RSI, it came down, tested it, got support at 50 there, came down, tested it, got support at 50 here last week, but MACD is still negative. So all in all, iFund is actually pretty simple right now. Weekly close above 74, and you're good to go. Otherwise, I wouldn't be going near the iFund. F fund, definitely the weakest of all of them. We got this frowny face, like JC talks about. We got weeks of consolidation below that 20-week moving average line. That is not good. RSI can't get above 50, and MACD is negative. So F fund is definitely not the place we want to be. All right. Questions?
I question my sanity right now trying to keep all this thing running.
I see, scrambling over there.
We've had a couple of IT problems, but that's always the way it goes. When you got all this crazy stuff that we have in our studio, we need a real producer. That's what we need. That could just be a smiling face. If you have any questions, you can put them in the comment section wherever you find this video. If you don't see a comment section, then just shoot us an email at support@growmytsp.com. If you like what you see, share it with your friends. If you don't like what you see, share it anyway. Hope you guys have a great week, and we will
happy 4th of July.
Yeah.
This is the 4th of July show.
It is.